Okay, I think we're going to get started. Just want to check with our technical folks that we have the Facebook Live up and running now. And it's so awesome to see people from all over the country joining us today. Okay. Well, we're at 281, still rising, but I think we're going to get going. Good morning, everybody. My name is Tzeporah Berman. I'm the International Program Director at Stand.earth. I also chair the Fossil Fuel Non-Proliferation Treaty Initiative. I'm talking to you this morning from Coast Salish territories, the traditional territories of the Tsleil-Waututh, Squamish, and Musqueam First Nations. And I'm joined here today by a number of experts from around the world, as well as in Canada. So thank you again for joining us on the webinar, on Zoom, or on Facebook Live. For those of you who have just joined, there's a chat function where you can let people know where you're calling in from, any other things that you want to chat about. At the bottom of your screen, you'll also see a Q&A function where you can put questions to the panelists that we'll be taking after they speak. The format we're going to take this morning is each of our panelists are going to speak for about 7 to 10 minutes. They've got some slides and images and information to show you, and then we're going to open it up for questions. So the reason we're here, just a teeny bit of context. So we're experiencing unprecedented and an extraordinary level of disruption in our lives, of course, and also in oil markets. The use of fossils during COVID-19 has plummeted. Many experts are now predicting that demand will recover to what it was, and that it is that this drop is in fact speeding up the potential of peak oil, a topic that we'll probably talk about today. The conversation in Canada is fraught, to say the least. And in fact, quite toxic. It's often very difficult to separate factual information on what's happening in the country and what the future of oil should be for Canada, not only for our economy, but also, of course, as we work to address the climate emergency. So this week, we saw the conversation erupt, and last week, a conversation around whether or not oil is dead, what the future of oil will be. Premier Kenney and others have said that even questioning what the future of oil is somehow unpatriotic. Yet, of course, many of you will have seen that Stand.earth released data that we got scouring company reports in the Bloomberg terminal this week that shows that, in fact, 70% of profits from the oil sands are leaving the country to foreign investors. So what is the future of oil in Canada? What does it mean for our economy? First, we're going to look at some international trends to get outside of this debate in Canada, look at what's happening around the world. And to do that, we have our first speaker, Kathy Hipple, is with the Institute for Energy, Economics, and Financial Analysis. Kathy, thanks for joining us today. We can hear you.
Okay, thank you. I'd like to share my screen, and thank you for that excellent introduction. Is it sharing yet? Here we go.
That looks great.
Terrific. So I know we're going to have a deep dive into what's happening in Canada from all the excellent panelists. So I am going to step back and give a global perspective on oil and gas. And I think that will set the stage, hopefully, for the next period of time. The bottom line is that the decline of the global oil and gas industry began a long time ago, long before March, long before COVID, long before the oil price war. So that is the spoiler alert. Now let's dig in. So as Tzeporah mentioned, I'm a financial analyst at the Institute for Energy Economics and Financial Analysis. And we call this IEFA. We normally have an in-person conference every year where I've met many of you, including Tzeporah each year. We have produced reports in the United States, more than 200, focusing initially on coal as the fossil fuel we were working to critique to see if there was any financial reasons that it should exist, and found that it really was not economic. And then we began moving into Asia and Australia, where we've done numerous reports. And now we are very active, as you know, perhaps in critiquing the tech frontier oil sands mine. We've done a number of reports on the Trans Mountain Pipeline, etc. We're doing quite a bit of work also in Argentina. So we really, I think, bring to the conversation a global perspective, which can be very helpful. As you can see, there are areas where we're not doing as much work as we would probably like to, which are some of the state-owned enterprises, which we're also beginning to move very heavily into because they're a big piece of the story. So the overview of my talk is that production of oil and gas is booming, and this is still happening. So as we will discover, companies don't just immediately say, we have a glut of oil and gas, let's stop all production now. It continues, there's a lag effect, but it is still booming. The boom really has been propelled by unconventional production techniques. We call this fracking, the long horizontal wells, the hydraulic fracturing in the United States. Also, another form of unconventional production, our oil sands production. So that's a different kind, but when we think of it, we think of what's caused this boom has been the so-called shale revolution in the United States for both oil and gas. What I have been focused, and my colleagues at IEFA, is that the financials of these companies and these industries has been a bust. And it's not well understood that an industry that is producing prodigiously and producing efficiently from a technological standpoint in many respects is financially a disaster. And this did not just happen overnight. This has been going on for at least a decade. And we now have individual oil and gas companies that are in extremis. Okay, so in March, in case anybody here has been living under a rock, the world completely changed for the oil and gas industry. We had an economic slowdown brought upon by the coronavirus. Demand forecasts plummeted. There began a price war between Russia and Saudi Arabia, an oil price war. So for those of you who have emerged, not having seen the news for 2 months, you know that the world for oil and gas completely changed. What does the industry want us to think about this? They want us all to join them in saying that this was a black swan event. Who could possibly have predicted such an event? But the reality is this decline began a long time ago. In fact, over the last 10 years, the energy sector and the way the Stand..Poor evaluates energy is they put all the companies that are in traditional energy, oil and gas. So it does not include wind, it does not include solar. So these are oil and gas companies. For the past 10 years, this sector has underperformed the market badly. In fact, it has been in last place. And that was from 2010, the beginning of 2010, until the end of 2019. This decline has continued through this year. So this is a daily chart, and you can see on the bottom line are oil and gas companies, the energy sector. So we have more than a decade of history. A different way to look at it is not just what is the stock market telling us. We can really look at actual revenues and earnings. So if you look at all of the companies, the biggest S&P 5, Stand.Poor 500 companies, their aggregate revenues are higher than if we take out the oil and gas companies, the X energy, if you will. And it's a significant margin. And again, this goes back even longer, not just a decade. This goes back to the beginning of 2000. So we have ample evidence that the energy companies have underperformed the stock market. Their revenues and earnings have underperformed the larger economy as measured by the S&P 500. So a different way we might look at this is that back in 1980, the energy sector comprised nearly 29% of the S&P 500. They were a big part of the economy. They drove the economy. As of the end of March, they were less than 10% of that on a relative basis. They were just 2.65% of the S&P 500. And that's an astonishing drop. So we see that the world economy has grown, but the energy sector, meanwhile, has shrunk. So what this demonstrates is that the world economy can get bigger, but it does not have to be driven by an oil and gas sector that is also getting bigger. A different way, in case you haven't gotten the point yet, is that in 1980, 7 of the top 10 companies were oil and gas companies. And if you look at GE, it was very heavily involved in coal and very heavily involved in natural gas. So we could almost have said 8 of the top 10 companies were related to fossil fuels. By 2018, there was only one, ExxonMobil, and in 2019, ExxonMobil fell out of the top 10. So we have no oil and gas companies in the top 10. As you might expect, most of them are tech companies, some finance companies, one drug company. And there are only 3 oil and gas companies still in the top 100 in the world. So again, this flies in the face of what we have been thinking about, that we see all of these charts that show that there's been this massive production of oil. And you can see in about 2008 right here, fracking started, and it created this massive boom in oil production, the fracking boom. The same thing happened with natural gas. Some of it out of the Permian, which is the biggest area of fracking production, and they have a lot of gas that comes with the oil there, but also a tremendous amount out of Appalachia in the United States. But along with that fracking boom, we've seen this massive value destruction as these companies have been cash flow negative year after year for a decade. Now, granted, you can say they're not as bad. They weren't as bad in 2019, but that's because so many of them that would have been in the sample had already declared bankruptcy. So you can see that even when oil prices were higher and natural gas or gas prices were higher, these companies were losing money quarter after quarter, year after year. So these are the smaller exploration and production fracking focused companies. Naturally, if you lose money year after year, if you're cash flow negative, the obvious conclusion is you're going to have a lot of bankruptcies. And in fact, there have been over 215 bankruptcy filings with US and Canadian fracking focused companies. So then let's look at the bigger companies: Shell, Total, Chevron, BP, ExxonMobil, the so-called oil majors. They still pay very high dividends. They must be in good shape, is often what people say. But the reality is we did a detailed analysis and saw that the only way these companies have been able to continue paying the juicy dividends that they have been paying is not out of their operations from cash flows. They've had to fund their share buybacks and their share dividend by a combination of some operating cash flows, but increasingly issuing debt and selling their assets. So their cash flows from their basic mainline businesses, which are oil and gas, are not enough to pay their dividend. And this trend continued through Q4, and we're just finalizing our analysis about Q1. It does not look good. So these companies that were once very large companies, in a sense, are cannibalizing themselves to continue to pay dividends. So we now have an industry where the small companies are really struggling and the big companies are also struggling, and the whole industry is in massive disarray. So, for example, they're not moving in lockstep anymore. It used to be the companies more or less moved in lockstep. But now we had Shell saying, we cannot afford to fund our dividend. And they basically decided to cut their dividend drastically.
Okay,
Others are continuing basically to pay their dividend, but they're recording huge losses and cutting back on CapEx. And then if you think I'm being a very Amero-centric or very US-centric, I'd like to just point out that some of those companies that we follow are European oil majors who have also suffered, but this is a worldwide global phenomenon. So there's a big shale formation called Vaca Muerta. It means dead cow. I've got a nice picture of it here. And it's the second largest shale formation in the world. And it's in Argentina. And they have had a massive amount of problems trying to develop their shale oil and their shale gas. And this happened, we have been reporting on this for 2 or 3 years. They've been trying to develop this resource. And they were having issues all through 2019. And then the pandemic and plunging oil prices have pushed production, any new production, there still is existing production, but pushed new production to nearly zero at the moment. Again, it's not just the United States. Saudi Aramco agreed to pay dividends to shareholders, but also to return a lot of money to the Saudi government. It looks like they've already, after just having a public offering late last year, have already decided they might need to cut their government payout. Suncor, closer to home, recorded huge losses and had to take a lot of asset impairments. So we're going to have a situation where the latest forecast by EIA, just in May, is that there will be a plunge in both production and consumption, but it will return to something like the pre-COVID level. So we know that EIA often is overly optimistic about their forecast, but I don't know that we can count on the consumption and the production declining as fast as the oil companies might like it to. In fact, we are quite pessimistic about that. And I'm going to turn it over to the rest of the panelists to say, what implications does this have for the energy sector? And then specifically, what implications does this have for Canada?
Thank you so much, Kathy. So much there. I have a million questions, and we're already seeing so many questions come in on the chat. If you could just click the stop sharing your screen button, that would be great. Thank you so much. For those of you who may have just joined us, at the bottom of your screen, there's a Q&A function where you can add in questions. If you want to add in your email address, if we don't get to them, we will send you written answers. I notice Pete Erickson is already answering some right away in the chat. He's multitasking. That's awesome. So we're going to move over now to Pete. Pete is with the Stockholm Environment Institute, and he's going to examine some of the risks of new oil and gas production in Canada. I'm just going to share my screen, Pete, so people can see your presentation.
That's great. Hi, everyone. Very glad to be here. My name is Pete Erickson. I'm a senior scientist with Stockholm Environment Institute. I lead the climate policy group here. I am based in Seattle, Washington, in the US, and much of my work focuses on the economics of oil and gas and the climate implications of oil and gas. You can go to the next slide, Tzeporah. These are some of the key points I'm going to make. I won't repeat them here verbally because you can read them. Instead, I'll just say that what I'm going to try to do in my few minutes today is give a picture into where the landing place for oil markets, for oil price, for oil supply and demand might be in a post-COVID world. There was a great question that came in over the Q&A. That's essentially what I'm going to try to get to. And I don't think anybody has a good crystal ball for this question, or rather a very precise or accurate one. There's lots of unknowns, but what I'm going to try to do is talk about some of the fundamentals and give some tools to help think about this question. Next slide, Tzeporah. And the main basic tool I want to talk through here is just simple supply and demand analysis. Well, maybe not so simple, but it's simple in the sense that it's economics 101, by which I mean is pretty good evidence that in the long term, that oil price is pretty well determined by long run features of supply. In other words, how much it costs to produce oil, and demand, how much consumers will pay and expect and demand at each different price level. And this chart shows that. It basically looks a decade out, say. That's what investors and folks planning on new oil fields are looking at. And on the left, it starts with, well, it shows all of the possible new sources of oil in the world. Each block shows oil from a particular country. The darker blocks are fields that are already producing oil. The lighter colored blocks are fields that have yet to start. They may not even be discovered yet in some cases, but oil industry consultants and analysts put together data like this that I'm drawing from. Specifically, this is adapted from Rystad Energy. In any case, what we see on the left is that there's lots of oil in very low cost, already producing fields in places like the Middle East and Russia. Over in the US, there's a lot of potential new but higher cost oil on the right side of the chart. And then there's lots of other sources in between. I called out Canada's fields specifically here, many of the oil sands fields, in little slivers of dark blue. These are ones that are already producing. And then there were tiny little slivers that spread throughout that we'll talk about a bit more later, fields in Canada that haven't yet been developed, especially from shale oil and tight oil. Not so much from oil sands. The thing I love about charts like this is that it helps you figure out, given your view of where demand and supply might be in the future, where things could land. Over on the right, you see this thing labeled oil demand curve. That's where most analysts, a year ago, thought oil demand would be in, say, 2030. Well, maybe not most analysts. Kathy probably would even dispute that, but a widely shared view that in the next decade, oil demand might increase from where it was last year, 100 million barrels per day on average, up to something more like 105 million barrels a day. If that's your view, if you think that's going to happen, if you're willing to place bets on that, then new investments in the Permian in the US and in some of the Canadian tight oil and shale oil makes sense. We heard reference to that view earlier from Tzeporah, that some folks, many in Alberta still take that view. But look at where demand has been in April of this year, in this little gray line in the lower part, 70 to 75 million barrels a day. If demand stays at that level, one might expect prices to stabilize again in the long term. There are other short-term dynamics at play, but in the long term, more like at $50 a barrel. Now, I want to point out something that might be encouraging to the oil patch in Canada, which is that most oil sands producers can cover their daily cash costs at $50 a barrel, even at $40 a barrel. Now, that might be good news for workers who need those jobs, who want those jobs. It's still terrible news for investors, as Kathy pointed out. Those investors were expecting more like $80 a barrel, so they're losing their shirts still. That's why you see a flood of capital from the oil sands to this day, and why new projects like Tech's project that they withdrew don't make sense. There's almost no new oil sands projects in this curve because almost nobody really has confidence that oil prices are going to be up at that $80 to $85 a barrel level. a chart like this also allows one to think through possible other scenarios, even a doomsday scenario in supply, where, as we saw just 6 weeks ago, Saudi Arabia and Russia teamed up to basically, while demand was decreasing, flood the market with supply, dropping prices even further. You see how much low-cost oil they have in this chart. They could, in the long term, I'm not saying this is likely, but they could take that as a long-term strategy and undercut almost everyone else higher up on this cost curve. That's a risk at least worth thinking through. Next slide, please. This chart pulls out just those Canadian fields, just so we can get a sense of where some of that new Canadian oil might fit in different places, in different price scenarios. And the stuff over on the right is much more at risk. That's new oil, new shale oil, new tight oil, as I mentioned, in places like Cardium, Duvernay, Viking formations. And yeah, there's still quite a bit of risk at prices, over, at prices, of $50 a barrel or more. There's very risks that if prices don't go back up to that level, even formations, even fields in the Montney could be very much at risk. And as we've seen, like Suncor, Fort Hills, for example, Fort Hills oil sands, one of the higher cost oil sands producers, has already sort of done a partial shutdown in today's oil price environment. Next slide. So there we go. What one's view is on the future market, where it's going to settle out, really depends on which of these factors in these lists you think are going to win out. But the one I want to just highlight here, because I'm getting close to time, is the climate and the policy response. Because in a climate safer world, where the world moves towards the kinds of commitments that Canada's government helped push for, the 1.5 degree temperature limit, oil demand needs to be plummeting. Next slide. There is a research report put out last year by a consortium of research groups, including SCI, but also IISD, based there in Canada, and the UN Environment Program, that looked exactly at what pathways for oil and gas and coal production would be under different climate limits. You see under 2 degrees, but especially under 1.5 degrees, oil production needs to be going down. So climate leaders that have pushed for these goals, this is the kind of oil markets that one would be expecting if those goals come to pass. That puts a lot of Canada's oil, especially its new oil, at risk. Next slide. I think probably don't have time to go into LNG. I'd say the economics of LNG Canada are even more risky than for most of the new oil that we talked about. Maybe we can get into this later. Next slide is, I believe, just a summary of the key points. There, you can read those again there, and I'll stop so that we have time for other folks. Thanks very much. Again, my name is Pete Erickson.
Thank you so much, Pete. That was a lot of information in a short period of time. Again, folks, if you want to put your questions in at the bottom of Q&A, we're going to try and get to as many as we can. We're going to turn now, which addresses some of the questions that I've seen coming up, to the question around the political economy. There was a great question I noticed in the chat earlier around how do we shift to renewables or away from fossil fuels when the ideology, when leaders cling to the ideology and support for the fossil fuel sector. I think that's a great question to introduce our next speaker. Professor Angela Carter is from the University of Waterloo. She'll be speaking to you today a little bit about some of those issues around the political economy. And I think you have a new book coming out, is that right?
Yeah, absolutely. Actually, I will show that off in a shameful self-promotion as we move through. All right, so Tzeporah, you asked me to speak a little bit about the petropolitics in the Canadian context, and I'd like to do that with a focus on the petro provinces. So these are our 3 largest oil producing provinces in Canada: Alberta, Saskatchewan, and Newfoundland and Labrador. Oh,
I'm just checking. Do you see that on your presentation on my screen? No, hold on one second.
Actually, I don't quite need it yet.
Okay, let me know.
Okay, thanks. Just give me 1 second. All right, excellent. So I would like to take a step back from the climate and financial imperatives that Kathy and Pete have presented to consider the formidable obstacles that we need to overcome to untangle ourselves. Pete had that great word on a slide of his. So over the next 10 minutes, I'm going to provide a snapshot of the place oil occupies in these provinces and the dual government and industry pressures to expand production. I'd like to unpack how these governments and industry have responded to a most recent crisis, the post-2014 price decline, and what they seem to be doing now. Also, I'd like to throw into a question the jobs and revenue argument. So I do this all to help frame out a conversation about where we go next and how we do that. So the first thing I'd say is that at the start of commercial production, oil in these provinces was imagined as nothing less than an economic savior. And it was a way to diversify away from previous industries that had gone bust and transition from being poor colonies within Canada. Oil was hailed as an economic miracle, a lifeblood in Alberta, a chance for a place in the sun in Saskatchewan, or an opportunity in Newfoundland and Labrador for us, it's my home province, to be masters of our own destiny. So this is some really powerful language about the importance of oil in these places. Successive governments seized on oil as an economic last chance, offering wide-ranging enticements to kickstart the sector. Now, by the mid-2000s, these provinces were in the midst of remarkable economic expansion thanks to oil. But this was and is increasingly based on extreme unconventional oil, tar sands, oil sands in Alberta, fracking in Saskatchewan, and ultra deep, very far offshore in Newfoundland and Labrador. So this is what journalist Nikiforuk called the ugly, difficult, and tough stuff at the bottom of the barrel. So that's been the source of our wealth from the petro provinces. So, you know, if we look at standard measures of revenue and exports and GDP, we see that during, you know, what I call this boom decade of 2005 to about 2014, striking dependence on those measures. Of course, huge environmental toll that came along with that intensifying extreme extraction. That's been dismaying, to say the least, especially the climate cost. Yet even at their richest point in history, when they were awash with oil revenues, the petro provinces weakened their environmental regulatory systems. And so on that first slide that I've got for you there, it's got some contact information for me, but also it shows a book that's coming out in the fall, new UBC Press book. And basically I, perhaps in excessive detail, outline how all three governments allowed regulatory capture to wilt, or they actively undercut it, all at a time when oil production was reaching unprecedented levels. Could you show slide 2 there? Okay, so meanwhile, very powerful and well-organized corporate interests have worked for decades to secure access to oil extraction, convincing governments to stay on the oil extractive path. So the Corporate Mapping Project has done a lot of the heavy lifting here to document what social justice and environmental advocates have long suspected, that there is a well-connected pro-oil complex at work in Canada that is pressing for oil extraction. Shannon Dobb and Bill Carroll outlined the vast labyrinth of fossil fuel industry connections to government and public institutions, what we might understand as modalities of corporate power, shown here. And a third slide, please, slide 3. So Carroll later demonstrated the interlocking board directors and executives, so presidents and CEOs that are employed by 2 or more corporations, connecting companies to each other over a range of sectors. And this is our pro-oil tangled web, to use his framing. On the next slide there, slide 4. What we're seeing now most recently out of the Corporate Mapping Project is a database that identifies densely organized carbon elites, the who's who of big oil, if you will, that wields a great deal of political power in Canada to promote oil extraction. So all this to say, you can end those slides there now for a moment. I've just got another couple in a moment or two, Tzeporah. So all of this to say that Canada's major oil producing provinces are internally motivated to foster oil extraction while also being pressured by really powerful industry actors. So what do they do when crisis hit? So we had a pre-show actually in 2014 when we had a fall in oil prices and all three petro provinces were reeling from the fallout. But rather than rethink the follies of oil dependence, each one doubled down on oil production, vowing to increase, and in the case of Newfoundland and Labrador, to double oil production, climate be damned. Today, with COVID, the pressure is even more extreme. While many Canadians in those first days were struggling to adjust to life in COVID, in March, oil firms and associations went into high gear, taking advantage of the crisis. There was a notable uptick in lobbying by CAP, the Canadian Association of Petroleum Producers, in those first weeks. And so what are they asking for? March media reports indicated that the sector was asking for a bailout between $15, maybe $20 billion. But as we saw in a March 27th letter from CAP to our federal natural resources minister, the oil sector was using the crisis to submit a regulatory rollback wish list. There was a 13-page letter that asked the government to adopt a do no harm principle with respect to the industry. So I'd just like to take a moment and say that, I find this is such interesting framing. I think that we should be asking the oil sector to do no harm. I think we should turn around that question. But in any case, the oil sector was asking the government to do no harm, to protect the sector by deferring, suspending, or waiving a whole suite of policies and regulations, including reporting requirements for greenhouse gas emissions, even lobbying reporting, freezing the carbon price, delaying clean fuel standard implementations, and so on. Even delaying UNDRIP legislation on the rights of Indigenous people. The petro provinces have stayed the environmental or the oil extraction course. And Kenny, for example, recently argued that the Albertan economy, Alberta jobs, I'm using his words here, Alberta's standard of life, our ability to fund healthcare, education, social programs are inextricably bound up with the future of our energy industry. So according to political leaders and oil actors, the oil industry represents having a future for the petro provinces. But the story of jobs and revenues is not what the real story is not what Kenny and others have been conveying to us. If you could show slide 5, please, Tzeporah. So about revenues from oil to governments, David Hughes documents that, I'll just wait till you get that slide. Okay, great, thank you. So David Hughes documents that over the last 2 decades, revenues collapsed. They dropped by 69%, despite a doubling of oil production over that same period. So what does that mean? Companies are producing more. We assume they're making profit on that production, and governments, people, are getting less. Slide 6, please. As for jobs, Ian Hussey has recently showed that Canada's oil and gas sector cut over 34,000 jobs since 2014 and has entered into what he calls a permanently slow employment growth phase. Workers are shed by oil companies to save cash even as production is rapidly increasing. And then COVID happens and they ask for relief to save jobs, but they really mean profits. All right, so that's the end of the slides there.
Thank you so much, Angela.
Just one last point, actually, 2, if I may. What do we see the petro provinces doing now, given the COVID crisis, not deviating from their oil course at all? Before COVID hit, these provinces were really struggling. Actually, that's a vast understatement. In my home province, Newfoundland was on the brink of, Newfoundland and Labrador was on the brink of bankruptcy, wondering how it was going to cover the payroll of public sector workers. And then they reacted to the oil price plummet in really well-rehearsed ways. They deemed oil production to be an essential service. Alberta bought shares in the Keystone XL pipeline. and offered big loans to get construction going. Saskatchewan has offered regulatory relief measures, and soon we'll find out if future exploratory wells, some 100 wells off the coast of Newfoundland, will be exempt from environmental impact assessment. And this is all to hasten new drilling. Meanwhile, all of these provinces are asking the federal government to bail out the sector. Initially, it looked like Trudeau wasn't going to concede entirely, but now we know that maybe financial support for the sector was coming, but more quietly. On Monday, we just saw a large employer emergency financing facility measure that is allowing basically companies to access loans, money that's too risky for banks, that will be backed up by federal government financial institutions. I think an important question right now to ask is, what do we get in return for offering the support? Are we getting equity? Do we get ownership so we can have more public control over the future of this sector? What we know about the future of oil in Canada is that when oil becomes a stranded asset, then these petro provinces, their workers and their communities are likewise going to be stranded. This crisis is yet another eyes wide open moment for the petro provinces, or it could be, when it's obvious that we've got to manage a wind down of fossil fuels. But to do this, as I've outlined in the last few moments, we've got formidable obstacles to confront. Thanks.
Thank you so much. So a couple of things before we continue. First of all, we can, and with our experts would agree, at least I hope many of you, go past the hour. So we may do that because we have so many questions. I'm going to queue up a couple of questions that are coming repeatedly. People are even lobbying me on my cell phone, so I thought that was inventive. Go engaged audience. Kathy, Pete, people are interested in your views on the Trans Mountain Pipeline project and whether this is still a good investment for Canada, given what you've said about oil price and the oil and gas sector. We have a lot of interest in whether it's true that there are big new markets in Asia for both our oil and for LNG developments from British Columbia. Angela, there's folks asking about, are oil reserves part of our heritage? And if they are considered part of our heritage, how do we move past those politics and cultural politics? And for everyone, is divestment of fossil fuels increasing? Seems to be from the oil sands. People are mentioning the big announcement by the Norway Sovereign Wealth Fund today on the top 4 oil sands producers. And what does that mean for Canada's economic future? Just a taste of what people are thinking and talking about on the chat. So we will continue to take questions. If after this, we will go past the hour if you can stay with us. We've got 356 people on Zoom now, and I don't even know how many people on Facebook live stream. This is an important conversation for our country. I'm really glad that you could join us today. We're going to turn now to look at the transition. Some thoughts from Alberta. Professor Mishka Lysack is joining us from the University of Calgary, has done significant work both in Canada and around the world on the energy transition and also on renewable energy. We're going to turn now to you, Mishka, and then we'll go over to some of these questions. Would you like me to share your slides right away?
Yes, please. Yeah. Thank you. So thank you very much for inviting me here, and I've very much enjoyed the presentations that have already happened, and I think there's a lot of really interesting and very important information that we need to address, and especially some of the questions, both implicit and explicit, that I think the other panelists have raised. I'm going to cover a couple of areas, and I'm going to try and keep it short. I'm saying that more to myself than I think to anybody else, but just to kind of remain focused, because I think the conversation is very important, especially in terms of how can we move forward. So the first area that I want to touch on fairly quickly is what does the polling data suggest? And this is from some CBC, or at least was covered by the CBC. It's actually done by Janet Brown Opinion Research, and you can see for yourself in terms of the slide that the three kind of key questions are: Alberta should do more to encourage the development of the technology sector, of which there's very strong endorsement of that, 92%. A big part of that is because there's been a long history for the last, certainly probably 10 or more years, of investing in the technology, and in many different ways, everything from stuff including even movies and so on, but to other kind of technologies. But unfortunately, the investment has been intermittent, and a lot of people in those firms have really felt that they didn't have any choice but to move elsewhere. But the main point here is this is kind of the overall question: should Alberta do more to encourage the development of technology? The second question, Alberta should transition towards renewable energy. So here are the numbers: 79% are supportive of it. That's quite honestly higher than I thought it was, and here I am in Alberta and in Calgary and at the University of Calgary, and but I'm very pleased to have seen that there is strong interest in that, and I don't think it's mutually exclusive of anything else, because I think you see the next question: Alberta should transition away from oil and gas, and while there's a slight majority for 51%. Who are endorsing that, which also is higher than I would have thought. I thought it'd be slightly lower than that. That nonetheless, there's strong support for staying with that particular oil sector. But I think the important slide really here is that there is strong support to moving towards renewable energy. So what would be the kinds of maybe things to highlight? And there are three they're going to mention, but there are only two covered by slides, and I'm going to talk about the last one, which is health. But the first thing is in terms of it generates employment. And the two countries that I'm particularly interested in, and especially because they've in some ways chosen different pathways, one's Germany and one's the UK. The ones we're going to talk about here right now are Germany, but I'm also happy to talk about the progress a little bit later that the UK has made. So I think you can see from the slides and that certainly the jobs have been very strong. The job creation went through a dip, I think, when certainly China flooded the market with very cheaply produced solar panels and so forth. But for the most part, it's recovered, and I think that certainly the employment is still more in terms of renewables and kind of the associated technology, especially around smart grids that are also cyber secure and have a strong capacity to dispatch electricity from a certain place that has extra supply to where it's needed, and vice versa, to respond to those places that don't have it. Next slide, please. Okay, so these are numbers that are somewhat old, but I think it still gives you a good sense of the size. It's I think it's about 350,000 jobs now, and you can see that most of that is certainly in the wind and solar sector. A big chunk until recently has been in biomass and bioenergy, but that's decreasing, and I think that's in part because I think the opinion of in Germany itself is shifting more to solar and more to wind as well. Next slide, please. Okay, and these are different things. We'll just kind of zoom, if you pardon the expression, through some of these slides. But the next one is, this one I think is a different area, which is what's the job creation potential when you compare fossil fuel industries to other industries? And as you can see, that certainly natural gas and coal, and this is per unit of investment, that there's, if you have the same unit of investment, that natural gas produces 5 per unit in terms of, it's an investment actually of $1 million, but also 7 in terms of coal. But if you start to look at wind and solar, you're starting to get more job creation potential. But as you start to add in other things, then because you just can't just generate electricity without grids, so we would need some kind of smart grid, and this is an area that I think is a real potential growth sector for many countries, including for Canada, and certainly Germany and other countries in Europe are moving very purposely on that. But then, of course, you're going to deploy that decarbonized grid to support, as you sort of look down the chart a little bit, to support certainly sustainable transportation and electric vehicles and so forth, decarbonize the heating sector as well. And I think what you can see is that it's not just additive, like it's not just addition, but it starts to have a multiplier effect. And I think the potential there, given the right investment climate, given the right government support, which is a question mark, given what we've presented earlier, but it's certainly a potential there. Next slide, please. Yeah, and here's a chart, another chart actually from this source. This comes from Robert Pullen's work. He's at the University of Massachusetts, professor there, but also director of the Political Economy Institute. I'll just skip over that to move on to the next one. Okay, and the third area, which is an area that I think is also very interesting, is how do we engage Canadians, or in my case as an Albertan, how do we engage Albertans? And are there a variety of different economic models? For example, in Germany, again, and you've got a German word in there as well, but what they did was they introduced something which most people have never heard of, which is ordoliberalism. Now, most of us, I'm sure probably all of us, have heard of neoliberalism and have some understanding of that. But in the 1950s, the person who was the economics minister, later I think became a chancellor, Ludwig Erhard, introduced a different model, a kind of a social economy model. And another way of describing that was for the German people and German communities, they had the opportunity to become empowered new stakeholders or direct what they call in Germany Energiewende, energy systems, and citizens, pardon me. And so this is a different kind of model, and the result of that was this not only explosive impact in terms of the expansion of renewable energy, but the direct involvement, and this was of course option or voluntary, it certainly wasn't required, but whether you were individual or whether you were involved in a city like Munich or a region like Osnabrück, which is a rural area, there's several areas that have already kind of moved in this direction and continue to move in this direction, even though the current German government is kind of dropping the ball on certain things in terms of changing how to bring on new wind and new solar. Next slide.
Mishka, just a note, we're at time, so if there's a really important piece you want to emphasize, yeah.
Okay, good. All right. Okay, well, let me just say, I'll just quickly, here's the sort of distribution of, and you can see that a lot of it is private individuals and farmers. It's almost half of that pie, so they have a high level of ownership. Next slide. There's the growth of energy cooperatives, which has been quite astronomical. That's plateaued off since 2016 with this new legislation, which we can come back to in the question and answer period if that's of interest. Next slide. Here are the regions as of 2014 that already have very strong levels. The darker green areas are very strong levels of renewable energy, and the lighter areas are those that are developing projects to move in that direction. You can see at that point, there's 21 million people. So that's important to know. That would be what? Maybe slightly over 50 or 60% in Canada. Next slide. And then quickly, maybe to end here, is also there's an option in terms of, I think, with Indigenous people. Next slide. I think many of you are familiar with the Siouxka Nation and Chief Gordon Planis. And with the description there, I won't read it, I think you can see it on your screen, something strong Indigenous roots, but they are also, or not but, and they are part of this new direction. So I'm just going to finish by saying that in a conversation I had with Chief Planis, who said that he was looking for a market reform in Canada for Indigenous nations to have the freedom and support to develop their energy resources, and he saw that certainly Germany was one that offered that option. So we can come back to that a little bit later and entertain other questions. Thank you.
Fantastic. Lots of information there for discussion. A couple of things for those of you, if you have to leave us on the hour. If you signed up and registered for this webinar on Zoom, or you put your email address in the Q&A or in the chat, we will send out the video of this webcast, as well as, with the panelists' approval, the presentations. So if you'll have more information to look at your leisure. We are going to go over the hour and have a bit of a discussion now. If you are leaving us, just to note as well that we have a second webinar on May 20th at noon. Stand.earth is hosting a webinar specifically looking at orphan wells, digging into the recent announcement and the, but also tailings ponds, the toxic legacy and impacts of fracking and oil and gas in Canada with a number of experts. We've had a lot of interest on the Q&A around solutions, renewable energy, diversifying the economy. We'll look at that for one of our next expert webinars. And on Mishka's last note there, I really encourage people to take a look at the new television series, Power to the People, hosted by Melina Lubicon-Massimo, which does an incredible job. It's on looking at different Indigenous communities and leadership across the country into renewable energy. I'm going to go back to some of the first questions now that we got, that I outlined. Over to you, Pete and Kathy, given what you've said about where the industry is and where it's going financially and on oil price, does the Trans Mountain Pipeline still make sense, or did it ever, as an investment in Canada by our federal government?
I'll handle that and then turn the LNG conversation over to you, Pete. Is that okay? So we analyzed the Trans Mountain Pipeline really before the Canadian government closed on that transaction, and suggested it did not make economic sense at that time. And that was before any of the legal issues came down. The Canadian government had agreed to buy it. They were the buyer of last resort. Kinder Morgan wanted to get out of this transaction. And we anticipated that any estimates they made beyond the purchase price, we at IEFA had done some analysis on what it might cost for construction, and anticipated that rarely do these types of projects come in on time and under budget. So it seemed as if that at that time, and this was a couple of years ago, that already oil sands were not cost competitive. And Pete had that fabulous slide showing how much cheaper it is to produce oil in the Middle East, and that it made no sense that, you know, sadly, for the heritage of this oil, it is trapped inland thousands of miles from where their end users are. And it's very expensive to mine this oil. So that it was really a project that made no sense then, and it makes far less sense today from a financial standpoint.
Thank you. for those on the webinar who are saying, as I've heard some people recently in Ottawa say, well, it's done. It's not done. Canada still stands to invest somewhere between 10 and 12 billion dollars if the construction goes forward, despite the many, many press conferences with hard hats and shovels. A very small percentage of this pipeline is now in the ground, only in Alberta and not in British Columbia. So taking a pause on this project and rethinking it, given the future of oil and the future of price, would make a lot of financial sense, especially given how critical those 10 to 12 and maybe even more billions of dollars are right now to be supporting Canadian families and workers through this difficult time. Pete, there's a lot of questions about LNG and also about energy demand in Asia, looking at whether or not there are new markets for Canadian oil and frack gas and LNG in Asia. Can you speak to that?
Sure, thanks. Let me take the LNG first and then talk about oil. There's a chart that I didn't really have time to get into, but about the economics of LNG Canada in particular. But the basic message is that break even, LNG Canada to break even needs a price of about $8, $8 US per KCF, per 1,000 cubic feet. That's one way that gas markets are priced. And to get to that level of price in the Pacific LNG market, you need two things to happen. You need demand in that market to go up, something like 50% over the next decade compared to where we are today. You also need to be able to outcompete the many other lower cost sources of gas that are vying to supply to that market. I'm thinking places like Qatar, Russia, Mozambique, and in particular, where there are very large, very low cost, in many cases already existing fields that are set up to supply LNG. So even, either a 5%, if those producers produce even 5% more, or the demand forecasts are even 5% too optimistic, LNG Canada loses its shirt, right? Okay, so now on oil, there's a question, I think there is going to be increasing demand for oil in Asia, given how rapidly that economy is developing. At the same time, they are making big pushes into electric vehicles. The economics of electric vehicles are such that within the next few years, we're going to see them being cheaper than gasoline and diesel vehicles in almost all markets. That is very likely to be a tipping point. Now, that may be a little bit at risk given COVID, too early to say exactly, but there are big downside risks to the very optimistic forecasts for oil demand in Asia that really could put the plans for big new investments in oil very much at risk. And IEFA and Carbon Tracker and others, us, we've done there's been a lot of work on that topic.
So a quick related question on transportation costs. We have a proposal in the country that would see oil going from the Burnaby Trans Mountain Terminal around down through the Panama Canal and then up the east coast of Canada to Irving Oil, which is currently being discussed. And while we're on the east coast, there's also a proposal for 100 new exploration wells offshore oil off the shore of Newfoundland over the next 10 years. So both of these projects being discussed in the news right now, being proposed to our energy regulators. Firstly, it seems to me that part of the reason that our oil ends up being uneconomic, higher cost than a lot of other oil in a lot of parts of the planet, is because transportation costs. The tolling costs on pipelines, etc. So the proposal to go from Burnaby all around the country and back up the other side Seems quite expensive. Wondering if anyone has any comment on that. And then, just again, the question of 100 new exploration wells offshore oil off Newfoundland, and given what you've said about markets and demand, are those a viable thing for Canada to invest in? And just a little warning, Angela, I'm going to be turning to you next with some questions around how do we expedite this shift? We need a paradigm shift to renewables. What are ways that we can weaken the ideological grasp of the petrostate? And Mishka, to you of whether or not Germany has suffered economic impacts in moving away from fossil fuels. But first, the transportation and offshore oil drilling. Kathy, Pete?
So, just the description of that, there's a global glut of oil. There's a global glut of LNG. So the idea that many times producers are myopic and they don't necessarily have a global perspective on the global glut. They're just focused on producing. And for some production facilities, it is expensive and complicated to stop production. So the obvious thing for those of us who are not necessarily engineers on a frac pad or whatever, it seems that if there's a global glut, wouldn't you just turn off production? Why don't they just stop production in the oil sands? And it is more complicated than that. The finances are complicated, it's complicated. But I think if you are desperate to sell your oil and gas, you will come up with endlessly creative solutions that make absolutely no financial sense. So I don't know if you disagree, Pete, but that makes no sense whatsoever. Transportation costs are very high right now, and that does not solve a long-term problem of a global glut.
I think I agree with the point that it's probably not a long-term solution. I haven't followed transportation costs, particularly in many cases. Once you get the oil in a tanker, it's actually pretty cheap to keep it going. So I would think that a bigger factor for at least Western Canada is access to markets and the discounts that can be faced, and that it may be in the short term worth it for them. With regards to the offshore, those projects in many cases do have higher break-even costs according to analysts, which would put them more at risk, at least in the short term. On the flip side, because they're big investments that last a long time, the offshore producers, in some cases, have the luxury of taking a longer term price perspective, so that the short, their plans may not be as much, or they may not see them as much affected by the short term hit in prices. But as Kathy's pointing out, there are enough downside risks in the long term to demand that would still, raise a lot of questions about the viability of those projects.
Fair enough. Angela, this question of, so given what you know, given what you're studying with the Corporate Mapping Project, how do we get out from under? How do we expedite the paradigm shift that's necessary? What are the steps that we can take? What are the steps that government can take?
That's I think we could have a webinar on that question.
Maybe we should.
I think it was a great, that would be a great topic. So in new work that I'm doing now, I'm looking at the first movers in the world to try to keep fossil fuels in the ground. So there's a set of about 8 countries that have moved with legislation to do this. And the Stockholm Environment Institute actually has been publishing a little bit about these as well. And I think we can learn a lot from those first mover cases about how you flip the dial and how you make big change. I'm unpacking a lot of that right now, actually, over the spring and the summer, but certainly a couple of key points that come through that I think we can take advantage of here in Canada to expedite the shift, as you say. And I mean, I think key is what, in the political science literature we'll call constituencies, broad constituencies. And so that means having environmentalists and unions and Indigenous communities and leaders and, academics and people who are engaged in all different kinds of energy related fights, really being united with a bold vision of a future and a willingness to get there, as well as the non-fossil fuel industries, right? So the renewable sectors, for example. So making sure we have a constituency that can confront the very well-entrenched, well-capacitated power of the fossil fuel sector. So that entanglement that Bill Carroll and Shannon Daub and so many others at the Corporate Mapping Project have been mapping the intricacies of, well, how do we build a constituency that can match that? But of course, the ideas really matter. I mean, we live in a world where, you know, graphs and data mean a lot, but I think to take a more cultural perspective is really important here. So I'll just give you one example. In the case of Ireland, where they have moved forward with keep it in the ground legislation, well, where did that come from? It came in great part from the advocacy work of a Catholic missionary organization that had done work in sub-Saharan Africa and had seen firsthand the impacts of climate crisis-induced drought. And they could see then, as you know, a developed or industrial country, the way in which they were feeding into that problem. And they could come at the question of, you know, not just keeping fossil fuels in the ground, but divestment, divesting large public funds from a morally very legitimate perspective. Okay, so they had a very strong moral weight as well as political access. So how do we recreate that in the Canadian case? Like who can speak to what we need in terms of a future energy system with a lot of legitimacy and ethical moral power? So I think a lot of this work actually is it's emerging right now, which is why this is such an exciting time in Canada. But I don't think we're quite there, able to match the rhetoric of the fossil fuel sector. So I think that's where I would start. The other quick thing that I would say is what we're seeing in some of these other cases is that to get to really big political economic changes, it often starts with really locally defined campaigns that over time build capacity among people that scale up to you know, big legislative changes. And so I think, you know, when I look across the country, in Western Newfoundland, I know there's some people on the call from there now. I mean, we see a fracking mobilization that was able to be active to the point of getting a ban on fracking in Newfoundland and Labrador, which is an incredible thing, given all the things I've told you about the entrenchment of that province. So it's that kind of activity, but linked up across the country, that can push for something different and something better. Mm-hmm. Tzeporah, you asked me a moment ago about this notion of heritage. I can come back to that. I think that's a great question, but a really loaded one. So maybe I'll turn it over to someone else and we can loop back around to that.
Thanks, Angela. A couple of things that I want to note in the chat here. I've just put a link for those of you on Facebook Live. I'll just say it out loud to the productiongap.org. This is a report that the United Nations Environment Program and Stockholm Environment Institute and others produced last year for the first time ever. Many of you will know the emissions gap report, which is produced globally every year. Countries have to engage in the production of that data to show what our gap is on emissions. This is really the first time that we looked at how much fossil fuels are being produced around the world and what is the gap between what is produced and what the world can safely burn, 2 degrees and 1.5 degrees. Shocking results from that report. We have underproduction or construction. Something close, was it 120% more, 1.5 degree scenario, Pete. In that report, they look at some of the first movers. And so that's a good place to find a lot of concise information on the issue of fossil fuel production. And I just want to say, this is a very difficult conversation, not just for Canada, but for Norway, for Argentina, for Ecuador, for many producing countries around the world, because climate leadership has been defined for the last 30 years just on what we burn, not on what we produce. I think the idea was that the markets would sort out production, that price and demand would drop and the markets would sort out production, and we were responsible as a nation only for dealing with emissions. Unfortunately, that's not working. It was a theory that in fact didn't work. We're not reducing demand fast enough globally as a community. The result is that we're locking in more production than the world can safely burn. So there's that. And then there's also, just for a country like Canada, where we have this high cost, high carbon oil, it's also a question of the vulnerability in our economy. It's for those reasons that a bunch of us around the world, analysts, lawyers, and economists, are now working together on a proposal that would be a parallel initiative to the United Nations Paris Accord, which is called the Fossil Fuel Non-Proliferation Treaty. And what it outlines there is a plan for fairness. A lot of you in your questions have been saying, what's the plan? What's the plan? The problem is very few countries, including our own, are not making a plan to wind down production. They're expecting markets to do it. The only plans we have are for our own emissions and our own infrastructure. That's a huge problem. And the result is we see these booms and busts and these declines that Kathy and Pete are talking about. And it is essentially a phase out or wind down of the fossil fuel industry, but it's not planned and it's not managed, and it's leaving, it could leave a lot of people behind. So I don't think anyone on this webinar or in their organizations are saying shut down the industry overnight. That's not viable. But I think what a lot of this data leads to is that expansion at this moment in history is a huge mistake economically and from a climate perspective, and that we need to plan for a wind down and diversify our economy. So I'm going to take this last question, and then I will remind people that we'll be doing future webinars, and we will also be answering as many questions as we can back by email to you. We'll be sending out the PowerPoints and a video link to this seminar to those that registered by email. If you want to follow our work on this issue, please sign up with Stand.earth. You'll be able to get our newsletters and see what we're doing. We have another webinar planned on May 20th on orphan wells, fracking, and the toxic legacy and what we do about that. I know there have been a lot of questions in the chat about that as well. So the final question, Mishka, is going to go to you on, and to others who want to comment on the German example. Has Germany suffered economically moving away from fossil fuels? People hold it up a lot as an example. What can we learn from the economic impacts of what they've been doing as they move towards renewable energy in the transition?
Okay, well, thanks, Tzeporah. So the answer is both a yes and a no. And a yes, they have suffered. And I did mention that in my initial presentation, that when China flooded the global market with solar panels and the basic kind of units of that, they did have a drop in terms of their employment. Obviously, the kind of amount of wealth that was generated decreased during that period of time. But since that period of time, they have recovered quite significantly, partly because they have learned to diversify greatly in terms of looking at the more involved technology of that, and how do they, like I mentioned, the grids and looking at how they can have these responsive clean grids right across Germany. They also have increased their involvement with cities and on a regional level quite significantly. And so through funding and so on, so there are a number of regions, and you saw that with the light and dark green areas, and so that's a bit different now, but that's continued to increase. And they also have done a huge amount in terms of research as well. So they're starting now to look at hydrogen and sort of more, I don't know if esoteric is the right word, more things that are a little bit further off and perhaps in the future, but doing that research, and of course that's been quite important in terms of job creation. Job creation has been uneven. It's been more in the former West Germany regions rather than in the Eastern Germany ones. And that's quite a complicated answer around that, because that's also related to lots of other things that we could talk about. The other model I just want to quickly mention is if we compared Canada to the UK. The UK has a different model in terms of their targets. They have a committee on climate change. They have a very sophisticated piece of legislation that they introduced in 2008. And what we see there, just to sum it up very quickly, is that if you look at the same time period, the UK has exceeded their climate change targets from the United Nations, where Canada we've missed ours. That the amount of megatons has increased in Canada that we've emitted, whereas it's decreased quite significantly in the UK, like minus 300 megatons actually. But most importantly is that's not affected their generation of wealth. That if you look since 1990, that Canada has increased its GDP per capita 37%, but the UK has increased by 44%. So I think whether you think of Canada relative to the UK, which has one model, and Germany, which has a somewhat different model, and this whole economic piece, which is different as well, I don't think we're in danger of that. I think that there may be initial trough in terms of some of the transition, but my sense is that especially because of the job creation potential, that I think that risk is less. It's not non-existent, but it certainly, I think, opens the way to seeing that whether you look at the UK model or German model, just as two examples, this would be true of certain states that have done the same thing, that I think there is real unrealized potential for Canada and for Alberta to move forward and generate those jobs and generate that wealth.
Thank you very much. A lot of people interested in what does the pathway look like as we move away from oil and gas and fossil fuels, both production and use. A couple of resources that I'm going to call out, and I'm hoping, panelists, if you have any others, you will let people know. A lot of the research that Professor Carr talked about through the Corping Mapping Project is available, incredible reports on that website. So the Corporate Mapping Project. On solutions, I mentioned Power to the People. This is an incredible television documentary series that is hosted on APTN television. Just search for it online. It is hosted by Melina Lubicon-Massimo, and she travels to Indigenous communities across the country who are already in the middle of the transition and showing incredible leadership in the development of renewable energy. For more on the solutions in Canada on renewable energy and the pathway for clean tech, high tech, and renewable energy, I would say that incredible resources at Clean Energy Canada as well. And a lot of people asking about Trans Mountain and the future of Trans Mountain. At Stand.earth, we run a Trans Mountain campaign. We're currently doing a push on insurance companies. I hope you'll join us. Take a look at our website, Stand.earth. There's ways for you to engage in the Trans Mountain campaign. Last word to our panelists. Any resources or final words you want to leave with people? I'm really amazed. Thank you so much to everyone. We still have 240 people on the Zoom. I don't even know how many people on the Facebook Live that have stuck with us for this hour and a half. Any last resources or comments? Kathy, I'll start with you.
I would say the IEFA.org site has most of the information I presented in my slides. I'm also very happy to share my slides. We do a lot of financial analysis on tech resources, which may be of great interest because they did back away from building what would have been the largest oil sands mine. But we've done quite a bit of financial analysis on the Trans Mountain pipeline, and there are people who will listen to a financial analysis in addition to their environmental impacts, that they may be more moved by saying it's bad financially than saying that it's bad environmentally. So if you'd like any of those, they're on the site.
So the Institute for Energy, Economics, and Financial Analysis, some incredible resources there. Pete, any final words?
Thanks. It's been a great conversation. I and a colleague are going to have a report out in the next couple of weeks that goes into the slides and the risks that I talked about for oil and gas in Canada in much more detail. So look for that. We'll be on our website, S as in Stockholm, EI.org. Thanks.
Thank you. Angela.
I've referenced a lot of material throughout. I'll share those slides so folks can take a look. It's been a pleasure to be with you all. Thanks for the opportunity, Tzeporah.
Thank you. Mishka?
The one that I was very interested in sharing with you is actually an article. Now, it just so happens to be an article that I wrote, but it's the only one I know of, which actually takes a behind-the-scenes look at the phasing out of coal in Alberta movement, which was used health as a dominant frame. And I think the two frames really involve economics, including job creation, but also health and how we managed to build strong partnerships with all four of the political parties and how that was accomplished. So I'd be happy to pass that on to you, and then you could certainly make that available in whatever way is best, and we can talk about that too, follow up on that. But I do like the conversations about who are the partnerships. I think maybe Angela, you mentioned that as well in terms of Indigenous peoples, renewable energy companies. I think that's where we need to start making these links, because that's how the coal phase out, or at least the beginnings of the coal phase out here happened. And thanks for great conversation, and thanks to Tzeporah for all the huge amount of work of putting this together.
Thank you very much. So join us on May 20th at noon. If you can, we'll be talking about orphan wells, tailings ponds, fracking, and the toxic legacy. Several Indigenous leaders will be joining us, as well as Ben Parfit from the Canadian Centre for Policy Alternatives, Reagan Boychuk from Alberta Liabilities Disclosure Project. Thank you very much to the team at Stand.earth for making all of this magic happen, and to our experts for joining us today.
Thank you, Tzeporah.
Thank you.